Our next speaker is Professor Kevin Davis. Kevin Davis is one of our eminent finance professors in Australia. He's a current panel member of the Financial System Inquiry Committee. He has a professorship at both Monash and at the University of Melbourne, and he's also the research director at the Australian Centre for Financial Studies. Kevin is a part-time member of the Australian Competition Tribunal and a co-chair of the Australia-New Zealand Shadow Financial Regulatory Committee. Please join me in welcoming Professor Kevin Davis.
Thanks, David. Thanks very much for the opportunity to come and participate in this event. And congratulations to CIFR on organising this and the other events during the course of the inquiry, which I think were very helpful. I've got to contradict David. I'm no longer a member of the panel. Our duties finished on the day we handed the report to the Treasurer, and from at this stage, our main role, I think, is to try and convince people of the merits of the recommendation. I'd also like to, thank David that, if my arithmetic is right, the time he's given me is 2 seconds per page of the report, or 15 seconds per recommendation. So clearly I can't get into too much in the way of details. So I thought I'd try and give some sort of broad picture of what we did in the inquiry. And I think, as a first point, one might have asked when the inquiry was announced, was it needed? Was the Australian financial system broke? Did it need fixing? I think in general people would have said the Australian financial system had looked pretty well. It had got through the global financial crisis, it was well regarded overseas and so on. But I think in general, just like a motor vehicle, it might be humming along apparently smoothly, but you want to lift the hood every now and again and have a look under the hood and see that everything is actually going well. And I'll use that analogy of a motor vehicle. I know nothing about cars, so I could go very, very wrong in this analogy. But what we were charged with doing was lifting the hood and having a look under it and seeing whether things were okay. And in that regard, when you lift the hood, you have to ask yourself, well, what are we going to look for? And so, as you're all aware, in the inquiry, we said there's 3 criteria we're going to look at. One is efficiency, in the context of the car. Is it getting us from A to B as efficiently as it can? Is it burning excess fuel? Are there too many costs in the system? Is it going the right way? Are the flows of funds being directed to the right parts of the economy? And of course, in all of this, our focus is not on the car itself, it's actually on the passengers. The financial system is there to serve the rest of the economy, the end users. And so the focus is very much on, is it performing the task for the end users? So efficiency is one. Another one was resilience. Is it going to break down and leave us stranded somewhere tomorrow, or at some stage, not necessarily tomorrow, but in the more distant future? And the third criterion was fairness. And I've sort of got to stretch the analogy a bit here and say, well, maybe this car's a taxi, and so we want to check that the meter hasn't been fiddled with, or that there are those sorts of issues that mean that the people involved, the people using the system, aren't getting a fair deal, that there are problems in the way in which treatment is accorded to different people in the system. So, given those objectives, how does anyone go about assessing whether in fact they're being met, or what the trade-offs are between them? And I guess there the philosophy of the approach, I think, is somewhat different to the Wallace inquiry, where I think one could characterise the Wallace inquiry, perhaps a bit unfairly, as saying there is a hypothetical, lovely world of economics textbooks where markets work, where there's perfect information, the system is stable, competition will always deliver good outcomes, and you minimise regulation as much as you can. And I think it's fair to say that we've learnt, both from experience and from research, over the intervening period, and perhaps before that as well, that yes, competition is good in general, reliance on markets is important, freedom of choice is very good, but it doesn't always work. And there are a couple of things that are important in that regard. The global financial crisis showed us, if anyone needed to be shown, that financial markets aren't always stable, that they can be subject to substantial disruption. There's a lot of evidence from behavioural finance and behavioural economics that people aren't that rational economic being so favoured by economists, but are subject to all sorts of behavioural biases. And it doesn't make sense to design policy for that mythical rational economic person. One needs to take into account the characteristics of people in designing policy. And in that regard, we need to be aware that financial literacy is not as high as one would like. I must say that we should teach it in the curriculum, Chris. Having been taught very, very good students at good universities who are specialising in commerce, when you see how long it takes them to understand the basics of net present value and discounting and risk adjustment, I despair about whether we can ever really hope that the average person out there who generally doesn't like maths is ever going to get on top of finance, and therefore they need assistance and protection. So anyway, our approach was to some extent a pragmatic one of saying, let's not compare where we are to some idealised situation out there. Let's recognise that any recommendations shift us from where we are. So let's take where we are as a starting point and try and work out what sort of moves can be made to make things better. So a very pragmatic approach, but very important underpinning all that was the emphasis that markets are important, that competition is important, and that choice is an important part of the whole approach. So what sort of recommendations do we come up with? Well, we lifted the hood, resilience. As I said, the Australian financial sector got through the financial crisis, but not without a lot of help from the government. There was a large number of actions taken that helped the Australian financial sector perform well through the financial crisis. Travelling around the world, one of the messages that came back to the committee was very much that don't assume there won't be another financial crisis some stage before too long. Despite all the global regulatory agenda of trying to improve the safety of the system, there are still lots of risks out there. So, as you'll all be aware, we had a number of recommendations on resilience, including increasing the capital ratios of banks to be in the top quartile of international peers. I think it's fascinating that whenever we tried to get into the area of using data, two things happened. One was there wasn't enough around, and secondly, making comparisons was very hard. So we got various people jumped up and down about our comparisons of international bank capital ratios, and also about the costs in superannuation. But I think we were on the right track there. So resilience, we thought, yes, we can do things to make the system more resilient. What about efficiency? Well, again, when we looked at efficiency, we thought, well, there are a number of areas in which improvements can be made. One of those is in the context of the costs in superannuation, whether in the accumulation phase the system is actually efficient, whether it's delivering the best value for money. Another aspect of efficiency is the extent to which people can manage the risks. Does the car have enough airbags, if you like? Are the airbags going to work? And one area in which we found that there was a shortfall there was in the availability of retirement income products, hence the recommendation for a CIFR. Now, there's some members of the Secretariat here, and I should actually pause and say an inquiry like this depends very much on the quality of the Secretariat, and we had a great Secretariat. Someone from here from the Secretariat might know why we decided to put the words in that order of CIPR. As I said yesterday, I think, well, CIPR rhymes with super, so maybe people can make up some nice little ditties about CIPR and super and something. But we thought that it was, that was an area where there was, if you like, a problem of inefficiency in the sense of not enough products to help people manage the risks associated with longevity. The third area was, the third criteria was fairness. And again, we looked at consumer outcomes in one of the chapters of the report and recognised that there have been lots of instances across financial advice, across the design and manufacture of products that weren't necessarily suited to people where there was scope for improvement. So we came up with some recommendations there in terms of responsibility for product design and a temporary banning power for ASIC. One of the things that I think is important to remember in all of this is that our objective was not to increase regulation. And some people look at those things and say, oh, that's an increase in regulation. But one always has to remember that regulation is designed to solve certain problems that might be caused by certain people or agents in the economy. And the trouble is, of course, unless you can actually discriminate very well, they apply across the board. And so lots of entities, for whom those regulations aren't needed end up suffering from them. I think in the context of those particular ones I just mentioned about manufacturer and distributor accountability and responsibility, you'd like to think that for any high quality reputable institution, that shouldn't be a problem. They should have those in place anyway. Likewise with the product banning area, you would hope that a high quality reputable institution would never find itself in a situation where they've put a product out that would require that particular response. So yes, there are some elements of regulation, but the objective is to try and reduce the need for other less desirable forms of regulation. Two other points. Of course, we know that going back to the motor vehicle analogy, there's all sorts of things potentially happening, driverless cars and so on. And what you would really like is to have in place a set of regulatory arrangements that facilitate the development of that technology that wouldn't preclude the development of this potentially very valuable technology, but which at the same time has risks, you know. The same thing's true in the finance sector, perhaps even more so. It's closer, I think, in the finance sector, where technology is changing dramatically the way in which financial services can be delivered and the operation of the financial sector. I look at that and say, well, you know, the main sort of things the finance sector does is overcome financial frictions, transactions, costs, imperfect information, and so on. What's new technology doing? It's changing the ways in which those financial frictions can be overcome to the benefit, hopefully, of all of us. But yes, there are lots of risks. And so among the regulations that among the changes that we suggested in the recommendations was that we should have graduated regulation that would enable the implementation of those new technologies and new financial techniques, but at the same time managing the risks. And so there are a number of recommendations in there on things like peer-to-peer lending, crowdsourced equity funding, payment system, which is one area where technology is rapidly changing things, trying to make sure that we don't stifle valuable innovation, but allow it in a way that means that the risks are managed until we get a handle on what exactly will come out of that. And finally, of course, and going back to the car analogy, you've got to have traffic cops, you've got to have parking wardens, and so on. And one of our, one chapter in the report, of course, looks at the regulatory architecture. Do we have the right allocation of responsibilities between the traffic cops and the parking wardens and all the others? Are they appropriately resourced for all the things they have to do? Are they accountable for what they do? And so, again, in the report, you'll find a number of recommendations on funding and resourcing of the regulators, on their mandates that they should take into account competition or the effects on competition of their decisions, and their accountability. And again, one of the recommendations was for a financial regulator accountability, acronyms are hopeless, financial regulatory accountability board as a way of trying to provide that form of accountability to ensure that regulators really focus on their mandates and take into account the things that are needed. I hope you found the report interesting. I'm sure you've all read it from cover to cover, and I hope you enjoyed it. Thanks.
Thank you, Kevin. Very interesting discussion. A couple of points. First of all, I'm not sure what kind of car we were driving, whether it was a Maserati or whether it was a Mazda or something like that. The other thing too is, I guess, car making in Australia has also been topical at the moment, but certainly very creative insights. So thank you very much, Kevin. Our next speaker is CIFR's Chairman, Peter Mason. Peter Mason is a Senior Advisor to UBS Investment Bank and also a Non-Executive Director of Singtel. Peter's been the Chairman of CIFR since inception, 2011, and he's also, as you can see from his bio, had very strong links and contributions to a number of activities at the University of New South Wales. Peter's formerly been Chairman of AMP, 2005 to 2014, Chairman of David Jones. He's also was Chairman of JP Morgan in Australia and Executive Chairman of their associate Ordnet Group. Prior to that, he had a long and distinguished career as Chairman and Chief Executive of Schroders Australia and Group Managing Director of Schroders Investment Banking businesses in Asia Pacific. Peter is more than an expert in this area. He's had a long and distinguished career in financial markets, and it's my pleasure to introduce him to speak.
Thanks very much, David, and good morning to all of you, and what an august group it is, which says a lot for the impact so far of what we're calling the Murray Report, and we'll continue to call it forever, but a report put together by a distinguished group, actually an extraordinarily experienced group of practitioners and academics and intellects, and as pointed out by Kevin, supplemented, in fact driven, by a first-class secretariat. And those of us who've been around for a while, Kevin, and a part of these things know exactly what you're saying about the importance of the secretariat. So a special thanks to those of you who are here and to the secretariat as a whole, recognising in particular that the time that was really available for putting together the report was very limited, given the breadth of the task and given the proclivity, which I'm sure would be right, as Chris Bowen said, that David Murray wouldn't let the terms of reference get in the way of what he wanted to say. And I compliment him on that. Just before I go to my own comments, I'd like to firstly recognise that Chris Bowen was very significantly the driver of the establishment of the Centre for International Finance and Regulation. It was his doing out of the Johnson Report that got us to where we are today, and I think in fact it was an initiative that probably had even better foresight than Chris recognised at the time he established it, and I'm going to come back to that. The Centre for International Finance and Regulation creates, as is called CIFR, maybe it rhymes with super, hadn't got to that, Kevin, but I can tell you that there has been much debate since its establishment as to whether the final word should be regulation or deregulation. And the two greatest proponents of the word of changing it to deregulation have been the chairman, the previous chairman, Wayne, I'm not going to put words into your mouth, John Laker, and the chairman of ASIC, Greg Medcraft, who have themselves said actually it should be deregulation because the role of the regulator is to try to get out of the way of, if you like, practitioner activity as best we can. So I compliment the two of them on that, but we've been blessed with the name we have, and so CIFR we continue to be. Chris Bowen has been a most thoughtful and clearly experienced and indeed somewhat cerebral participant in the financial services industry as a minister or as a commentator for a long time, and I'm disappointed he's not here. He's had to go to Brisbane to hear me say this, but boy, is he a significant power for good. And the very opening remarks of his about the reference to the desirability on the one hand and his determination to be part of on the other, bipartisanship in a lot of what comes out of our analysis and the implementation of the Murray inquiry has to be greatly, greatly welcomed. There is no question about his determination at a genuine attempt because I've seen him do it before. Wearing an AMP hat, and Craig Dunn can underline this, we had a lot of interaction with Chris when he was Minister, particularly in relation to superannuation, and he was always a good listener. We might have disagreed on things, but we never had any doubt that there was an open mind as to the viewpoints that were being debated. So I compliment him and his party on that. and it, I think, augurs well for all of us. I also like his comments about superannuation policy being for the long term, and the reference he made to potentially a 5-year cycle. Certainly superannuation, Pauline, is not something that should be looked at on a budgetary basis, and that's something that we've had, I mean, lots of agreement about over a long period. I'd also like to compliment his comments on dividend imputation. I think fiddling with the system would create potentially many unseen consequences. I think it's embedded, it's actually worked remarkably well, and while there have been arguments as to why it creates some forms of distortion in the system, particularly given some of the attraction there is for dividend imputation flows in superannuation funds and the growth of superannuation proportionately in our economy, there is no doubt that it should be here to stay. Finally, just to look at Kevin, you mentioned particularly the Financial Regulation Assessment Board. I know that that's something that was also in Chris's mind. I see it as being a very interesting potential development. I must say I'm mystified as to just how it might work in the long term, and somewhat fearful of that. And all I can say is I wouldn't like to be a part of it, because I think it'd be a very demanding thing to do. Can I just compliment you on the reference to two things in particular? One is behavioural economics. I mean, it's so right. There's no way that we can be formulaic in the way we think people are going to behave. And also to endorse your reference to financial literacy, because it does continue, I'm sure, to amaze all of the people in this room just how dumb some people, consumers, can be in relation to financial exposures, where we would all get the risks they were taking, but so many of them don't. The language can be mystifying, and I'm going to come back to CIFR's role in translating academic research, but a whole lot of academic research can be mystifying, and yet so many of the concepts actually are pretty fundamentally simple, and we do need to get it into the schools. It has to happen, and frankly we've been irresponsible as an industry in not pushing it harder. There have been some people who have taken a very strong view on this, but it has not been nearly effective enough, and it's something that we as practitioners, as policymakers, as regulators, as participants in an industry have a real responsibility for, and we've been culpable in not pursuing it much more vigorously. I'm going to just summarise my own views on the Murray report, but I think it's really gets to CIFR's views. And David, if it doesn't, don't tell me about it until the end of the day. The first, clearly, is that the report is wonderfully comprehensive. And I repeat that it was undertaken over a very truncated time period, so I compliment all of those who are involved. It really does identify the issues. Second point is that most of the 44 recommendations require a whole lot more additional work before they can be implemented. And that means time. And one of the issues we know arising from reports of this nature going over generations, and Chris Bowen referred to some of them, but I can go back even to the Vernon report and the Jackson report and the Matthews report and so on. One of the issues is that by the time the recommendations actually get to be deeply analysed, the next crisis of some sort has arisen and it's too late. So I think, again, it's incumbent on us as an industry to make sure that we do get forums together of this nature, and that we keep the pressure on both amongst the industry practitioners and with the policymakers and with the politicians to ensure that we push those 44 recommendations or dismiss them. But it's time for action now, and it's up to those of us in this room and those with whom we have our tentacles contacting to make bloody sure it happens. The next thing I'd point out is that it is in their own interests for the banks, the superannuation industry, investment managers and so on, actually to take some initiatives. Now standing up and resisting will not work. We've been given clear guidelines as to direction out of the Murray report, and those guidelines have a certain inevitability about them. I'll go, for example, to the recommendations in relation to bank capital. It is going to happen. We don't want to jump the gun on what is happening internationally, but we need to move with the international markets very quickly, because when the next crisis comes, we are not nearly as strongly situated as we were the last time to be able to maintain, if you like, our position in the financial world as a whole. And it's in everybody's self-interest to ensure that we take the lead. And the last thing, and actually from a personal viewpoint, maybe the most important thing of all I've got to say in the CIFR context, is that academia has a huge role to play in this, and as we are finding, can make a fantastic contribution. But on the other hand, the corollary to that is that academia has an obligation to ensure that the work that is being funded out of the public purse, and it almost all is, that work is actually up to scratch, both as to academic rigour, but more importantly as to practical executability, if you like, as to translation, so that the political government, policy makers and the rest of us can actually understand what is being found in the way of fact-finding and what is being suggested in the way of outcomes. And I'm going to come back to expand on that just a little in a minute. Underlying all of the 44 recommendations, Kevin, you talked about efficiency and resilience and fair treatment. There's also that strong bias towards competition within the report, and an implicit as well as explicit assumption in many of the recommendations that competition is at the essence of efficiency. The underlying all of those recommendations, as David Murray, whenever he could get in front of an audience, was pointing out, Australia is reliant on the import of capital, and we must have a system which in the tough times is going to be one that is recognised internationally as a good home base. I want to emphasise, as Kevin said, that the federal government did step in the GFC, despite some of the blinkers that some industry participants have put around themselves. Let me assure you that the day that the guarantee was effectively put in to underwrite the banks was the day that made a huge difference to the resilience of this economy. There are all sorts of other things, and there's no question that the banks were relatively well managed, relatively well capitalised and so on, but it needed a government to stand up in the face of the pressures of governments all around the world to say, we're in this together. And we must never forget that that happened, and we must recognise that the next time round, our government might not have the resources to be able to act nearly as comprehensively. So we better do it ourselves. I talked about most of the recommendations being big picture, in that they give a direction for policy or practical execution rather than a specific outcome, and they require therefore additional work to get down to the specifics. Some of that additional work is going to come from the regulators, some of it is going to come from industry, a lot of it should come from academia and the universities. I look, for example, at the recommendation 1 in relation to capital levels in banks and financial institutions generally, or ADIs. There's no question about the direction. The specifics are open to question. Time actually to get specific. And there's been enough work done in industry, particularly from some very clever bank analysts, and published already, both by UBS and by Brian Johnson at CLSA, that demonstrate that the big four Australian banks certainly have the resilience to be able to recapitalise themselves with over a sensible period of time and with relatively little potential impact in terms of their own shareholders. So I think the market's conditioned to that, and it's time we got on with it. I think the same thing applies to recommendation 2, which is about the narrowing of mortgage risk weighting differences. In fact, I, for one, having been in the industry for a very long time, was astounded when to read the report and realise just how subtle but how deep some of those internal models differed from each other, and I suspect that was an awakening for the market as a whole. Some of the recommendations are specific, and I think that they're sort of really beyond debate. I go to recommendation 8, which refers to direct borrowing by superannuation funds and removing the exception to the general prohibition on direct borrowing for limited recourse arrangements. And I would have thought that in terms, Pauline, of what we're looking for in a policy sense, it just makes good sense. It'll irritate some SMSF managers who would like to be able to finance their business premises in certain ways. I get that. But big picture, what we're looking for, and importantly, we are looking to actually define the objective of superannuation. Again, that was a sort of factor that we all thought was there until we realised it wasn't. Some of those recommendations definitely sort of beyond debate in my view, and I think we should hope that government will hurry with those. I was pretty impressed, Kevin, with, as I say to you, the reference to a financial regulator assessment board. I'm sceptical, I have to say, as to whether such a thing could work. But on the other hand, I think we've been blessed in this country over time with first-class chairmen of particularly APRA, ASIC and the ACCC, and I don't mean just the current, they happen all to be men, but the current bodies of commissioners in each of those are people who, generally speaking, widely experienced, who really get the marketplace and who work extraordinarily hard to get to sensible outcomes in a relatively short time. Now, let me assure you, and Wayne will testify to this, I've had my debates with APRA from time to time, big time. Never acrimonious, but very sincere. That's not the issue. The issue is that there was never any doubt that there was a mutuality of respect, and that we always have known that the people we're dealing with in any of those particular 3 institutions are absolutely right at the top of the tree in terms of their cerebral capability, their industry and their common sense and their ability to get things done. So I compliment them on that, and I'm saying I'm not so sure that we do need a financial regulator, but let's see how the debate on that evolves. There are some wonderfully open-ended recommendations from the report. One I like particularly is recommendation 19 about data access and use, which talks about reviewing the costs and benefits of increasing access to and improving the use of data, taking into account community concerns about appropriate privacy protections. Well, yeah, that's true, but boy, is that an open-ended debate that will go on forever and on both sides of politics. There's a reference to establishing a formal framework for cyber threats. Again, that's shooting at a moving target. I think that the recommendation 39 for what it is a very good one, but I think that we're going to find that that is way beyond our ability to actually execute in the short term. But I'd just like to come to one last one, which is my favourite, having been much involved in these things in an insurance company, and that is that there's a recommendation 43 about introducing a mechanism to facilitate the rationalisation of legacy products in the life insurance and managed investment sectors. And that, to me, is probably the most important of all the recommendations, and Wayne, probably the most difficult to execute. There are also some sleepers. I think the reference to competition and the potential to limit the benefits of competition in the future should be proactively monitored over time because of the high concentration in the industry, and in particular the state of competition in the financial system should be reviewed every 3 years. That looks as though it's getting to those whole questions of too big to fail and the 4 pillars policy and all of those sorts of things, and I think it's very subtly put, but I think it's going to be there are going to be grounds for a lot of continuing interest in those particular recommendations. Now, just briefly, I'd like to refer to the approach that we're taking in CIFR. We have sponsored this forum, as we have done a number of others during the process of the FSI, and we will be doing over the next 12 months or so as things iterate. One of the points that, of course, is that a lot of the research, we have now sponsored 70 research projects, plus or minus a couple, and many of them are just now coming to fruition. We are concentrating on very, very high quality output. And there's been some first-class work. I'd just like to compliment, because they're here, Ross Buckley I've seen in the room, Justin O'Brien, Valentin Panchenko, James Cummings, Jeff Kingston, Jeff Warren, some really first-quality work. One of our objectives is to translate some of that work, all of that work, so that it is not just available for publication in academic journals, but is actually readable by non-academics, including policymakers, and appropriate for the press. I'd particularly like to compliment Cliff Gadd, who's our CIFR's communications manager. He's been developing summaries of the reports, 2-page summaries, and they are remarkably effective, to the point where I won't read it, but I have a wonderful compliment from a professor of economics and finance who says, can't Cliff get hold of every one of our papers and refine them even for publication in our academic journals, because the job he does is absolutely first class. So that's part of our objective, is to make sure that the academic work which we are funding and endorsing is up to scratch and is reached by the wider public. And here I'm just going to make one final comment, and it's a very serious one, and I'd like it to be disseminated from those of you who have communications with academics. The issue we have been somewhat disturbed by, indeed in some cases dismayed by, is that there are a number of academics who have not proven capable of managing in accordance with budgets and have not proven capable of managing to timelines. And when I say managing to timelines, I'm saying there are even some projects that are more than a year over date. And we're starting to get pretty disturbed by that, because in terms of our own life cycle, we've got a job to do and we can't tolerate it. And we won't tolerate it, and we won't tolerate a lack of quality. And if that means withdrawing funding from some, then we'll do it. The vast majority have been fantastic, but there has been, amongst a couple, a tendency to hide behind academic independence or whatever it might be. Not acceptable. There's nothing to do with that. It's about your obligation to provide a return to the stakeholders of CIFR and the universities themselves and the other co-funders who are providing the opportunity for this work to be done, with the very sincere objective of making a real contribution to the Australian community at large and to the financial system as a whole. And we are going to be rigorous in pursuing that quality outcome. So I thank you all. I think it's going to be an interesting rest of the day, David. There's plenty to do, and I look forward to being a participant in it, and I congratulate you, David, and your colleagues on getting us to where we are. Thank you very much indeed. David, over to you.